Hi, Nataraj.
Hi Vishnu, welcome.
Thank you.
We're starting shortly.
Vishnu ji,
Okay.
welcome. This is Rammohan Bhave.
Hi, Ramanji.
Nice to hear very highly about you from our friends. So,
Pleasure.
I mean, in India, I am person means a superstar.
Thank you.
So you are originally from Bangalore only, or
No, sir. I am from Chennai.
okay?
So I grew up in Chennai, but I stayed in Bangalore and I worked around for a while.
Okay. So currently you are in Chennai,
Currently, I'm in Bangalore.
Bangalore.
Yeah.
So you are now settled in Bangalore.
I know I'm working here for past 7 years now. So
As good as.
yeah, as good as it.
Right. And how do you find the difference in Chennai and Bangalore?
Weather is very different.
Uh-huh.
And if you see the companies per se, Chennai has more of traditional companies. You have manufacturing, you have ITES. Bangalore has more of startup ecosystem and new age companies coming up. So that's a major difference. But otherwise, I see a lot of people from Chennai in Bangalore. Bangalore is predominantly, filled with people from all over the country. So you definitely, it's like a mini India now.
Nice. And how is the COVID situation?
COVID situation, at least in Bangalore, vaccines, all the companies are making efforts to get vaccines for the employees. So situation is kind of under control. At least most of the population have received first dose. And people are stepping out now. Some of the offices are opening up. In the evening, if you go, you can see people are coming to supermarkets, they're going to shops. Slowly coming out, but not. And you can also see traffic, probably it is 20% of what it used to be. But slowly it is coming back to normal. So where are you based, Operason?
Mumbai.
Mumbai. Okay. How is the situation there?
Situation actually, Mumbai is governed by local.
Right. Huh?
So if local is on, lockdown is over. If
Okay.
local is off, lockdown is there, whatever government may say.
Okay.
So 15 August, the local has started.
Okay.
Fully for everybody. But
Okay.
the condition is only those who have got both the vaccines.
Okay. Okay.
So normally the local traffic is 85 lakhs people. And I think currently we might have reached 30-40 lakhs.
Okay.
So you can say 50% people, I mean, the people who are required to go for work.
Right.
And here the distances are very, I mean, the time consumed in commuting is very high.
Yeah. All my friends in Bombay say that you live in one part of Bombay and travel to other part of Bombay.
That's right.
Yeah.
So, professionals sometimes don't have to go out. And many companies are still on work from home.
Right.
The shared services sector,
Right.
which is predominant now. And the banking and NBFC industry, which is also very high.
Right.
They are like 50%.
Yeah.
They don't allow the guests, visitors.
Right.
So like auditors are doing remotely, or any suppliers are not visiting. So that challenge is on. And I mean, what will happen in the third wave is all everybody's, and how fast the what should I say? How fast the vaccination gets done.
Right.
These two things will determine the situation of back to normalcy.
Yeah, that's true.
And how is your own job? You are at office or work from home still?
Work from home.
Work from home. Okay.
Yeah.
So what is stopping now in Bangalore to start work from office?
It is more convenient. And
In terms of employer's choice.
employer's choice, a lot of people have actually moved. Like I said, Bangalore is mini India. People have actually moved out of Bangalore. So you can see almost all apartments, there are at least 3-4 houses which are vacant, which was not the situation before.
Okay.
So people have to return back to Bangalore first, and only then offices. So once offices mandate that you have to come to work, only then people will return to Bangalore, and then I think full-fledgedly, people return to office will happen.
Okay.
So at least so some companies have started giving directions. From October, some have dropped hints. Probably January, Feb is when I think people will actually return to Bangalore and office will start working.
Okay. Good. I think we are at 6:30.
Right.
Natras sir, has Pramod Jain sir joined?
Sir,
He's joining in 5-10 minutes.
Yeah, he will join a little late. So what we will do is we will start with your introduction, your address, and after that we will go with AVP.
Yeah, I saw that. So that's okay. It's my pleasure to welcome all of you. Ram Mohan Bhave, President of Association of Valuation Professionals, a national society making a big progress very quickly. The very fact that we have been successful in getting the talents like Vishnuji as a speaker, it shows that AVP has made its name. We are proud that we are able to get such a high caliber faculty, and we are also proud that the number of audience is increasing day by day. And startup is the test of the day. Many of us will keep on getting the messages saying, Mr. Bhave, I have started. In fact, just because before 5 minutes, somebody rang up and told me, we are importing and selling bicycles and this is a startup. So can you help us with your valuation? So I am eagerly waiting to hear Vishnuji. And I mean, many of the people I saw that they tried to do IIM or chartered accountant as an option, and most of them end up in doing CA. But that itself proves that how much is the high worth of IIM and how IIM is the cream. In fact, I was being told by my IIM friends that if you are, I mean, 10 years, this is 10, 15 years back, that those who are IIMs, they generally not in India. So I'm happy to see that Vishnuji is in India. Of course, that was 10 years back situation, and those who were remaining in India mostly because of some family tie-up or sister ka shadi karna hai or parents are not so well. So they as a compromise remain in India. So whatever people remain in India, like Vishnuji, it is our advantage to take it is our opportunity to take advantage of their knowledge. Of course, with the online, there is no need to think of India. We can get speakers from overseas also. Having said that, our journal, e-journal, e-newsletter, what we publish, 6 issues are over. And it has been having very high quality articles. I'm sure you would like to go through them. We'll post some of them in the chat mode today. Apart from that, there is a webinar stream going on, and my colleagues will show you that. We are holding webinar every week practically, and more than 20 webinars are over. I mean, I lost the count, so somebody will give you the exact idea. And we are full up to next June, by where faculties and speakers are and chief guests are already decided. That itself shows that, I mean, like our dream that how Bombay Chartered Accountants Association, which is very highly respected, or Chamber of Tax Consultants, they are highly respected, or BMA, they are highly respected, and they have 1 year's program lined up already well set. We wanted to achieve some such kind of thing by, copying the best practices, to be frank. And very fast we are successful. The credit, of course, go to mainly Sandeep Kumar Agarwal, who is our head of our PDC, and all his colleagues like me and Natrajji and everybody. So, and that too with a very high quality caliber people. Pramodji is yet to join, but he is anyway famous because Central Council members of Institute of Chartered Accountants of India are well known to everybody. Reason being that today, all said and done, the number of CAs are almost touching 4 lakhs. And in bigger cities like Mumbai, Delhi, Chennai, Kolkata, Bangalore, Hyderabad, there every building has 4 or 5 CAs at least. So obviously the president of CA becomes famous, and we have Pramod Jain, a very popular personality. He's joining a little late because being a CCM, he always has a lot of. Before concluding my thing, I should once again appeal to all the audience who have joined here that become our members. And we have, what do you call it? Like government says, ease of doing business. We have ease of taking membership. And that membership is just 5,000 rupees. To your surprise, it is one time and lifetime. No money will be asked in future from you. There are no annual fees. All programs are online, and it's a national society. So obviously, if at all any physical activity happens later, that will be a particular event cost. But other than that, you have nothing to pay. And this is a national society, so you can have a national tie-up being done. And we are mentoring all the young valuers. My primary goal was that because today I'm on a mode on passion of teaching. So I said this should help all the young valuers to get mentored, because many of them pass the register valuers exam and say, oh, we have passed the exam, but when a new client comes, the new situations we are not able to handle, we said, don't worry, be fearless. We are there to help you. We already we already been spread into 34 cities. Okay, there are members in 34 cities, and I'm sure we will reach a record of 100 plus. Then we have 3 overseas members already. Okay, Dubai, Melbourne, and London. And the number of members who are slowly joining are from different countries. My dream is that we should have 150 cities and 30 countries members. My colleague Ravi Chandran is strongly working on tie-ups with the international bodies on valuation. So let's say Singapore, London, Canada, Saudi Arabia, America, USA. So he's working on that discussions. And in fact, nowadays we have started getting some of those people as an audience as well. Having said that, there are ample advantages of becoming a member. And we are also not interested in doing a huge accounting work. So there is no annual fee kept. One time and you are in. So we don't have time to keep track over whether you are paid or not in future. And at the same time, we work on a corpus model where the interest cost itself will take care of the workings. So today we have already 140 plus members. And after every webinar, in fact, 1 or 2 members join as it is. And our desire to spread the knowledge forces us to ensure that we keep all these programs free. But obviously, once our members cross 600 to 800, then our internal strength itself will occupy the full seats. So become members well before that happens and take advantage of this valuation wave. Vishnuji's biodata is too long, and there is a separate person to introduce him. So I will not get into that daring, but I am Bangalore. Once you write a word, I think there is nothing further need to introduce. That is the beauty of this IIM qualification. With this small introduction of the webinar, and request all of you to become the lifetime member of Association of Professional Valuers, I hand over to my friend Natras.
Sir, can you please make Mayur Deshmukh a co-host? We'll move on to next section where we'll have a short presentation on CVP. Mayur, or
Yeah. Just Natarajan sir, I am not a host yet. I cannot share the screen. Yeah, by that, good evening, everyone. I am Mayur Deshmukh. I will give you the overview of the agenda and how we are going to go ahead. Okay. So let's start with.
Just give me a second. Mayur, you are present with the name Mayur only, na?
Yes, Mayur Deshmukh.
Okay. Raj, can you make Mayur sir co-host, please?
Yeah,
Yep,
you are
done.
host Mayur.
Yes.
You can share your screen and present.
Yep. Share. Okay. Good evening, everyone. Welcome to Association of Valuers. Okay. So this is a good valuation platform, means association, which will help us to grow together to the next level. So in order to get CPARs, we have tied up with IIV India Registered Valuers Foundation. It's a Pune-based RVO. Okay, next. Yeah. So with this, we will today's presentation will be on challenges in startup valuation and fundraising by Vishnu sir. He's IIM Bangalore alumni. That itself tells us his experience and his knowledge, because once you go to that level, it is bound that you will be an outperformer. To give you more details about IIV India Registered Valuers Foundation, it is a RVO formed under Companies Act and rule. Okay, registered valuers and valuation rules 2017. Managing director is Amin Sheikh sir, and their main aim is to promote and develop the professionals of valuers. This RVO is contributing enhancedly by educating other members and getting new CPE programs continuously. They have conducted 50 hours of training program, and they do conduct for all the asset classes. Till date, they have trained 1,400 members, and out of that, 246 have successfully passed the exam and are recognized as a registered valuer with IBBI. Now coming to our association of Valuation Professionals. Okay, the beauty of this association is they just charge you one-time fees of 5,000 rupees. Imagine in a situation where there is a group of alumni who help you to grow. Okay, so
membership with organization start చేశారు.
Yeah.
Lifetime membership.
Yeah.
అంటే foreign countries
Chaitanya, can you mute?
వీళ్ళందరితో free webinars ఇవన్నీ దీని.
Yeah. So imagine a scenario like for me, it was one of the incidents. Like I didn't knew how to value ESOPs, and I have a client. Okay, so now this association was one point of contact for me. I just texted my query on the group, and a lot of people came forward to help me. So imagine the situations where you come across very different, varied problems, and you have entirely around 150 people helping you to get that client, keep him happy, and boost your experience. Okay, so this is one thing. So I would urge everyone to add more and more members and help us grow to the next level. Milestones which we achieved in last 6 months. Imagine we have tied up with the IIV India Registered Valuers Foundation, which will provide us CPARs, which is mandate for us. So this is one of the greatest achievement. 150 members across the globe means it's again a commendable job. So you have 3 foreign participants right now in the group. Apart from that, we also have ex-chairman BSc and past president of ICMAI. So see the beauty that we have a knowledgeable persons, and if we are just part of this group, we can encash all that knowledge. And the best thing is you can anytime approach these guys, so not with a prior appointment, or else with this group's help. So all your problems are solved. Apart from that, we also prepare newsletters to enhance our knowledge. These newsletters are published once in a month, and we publish 6 newsletters and 1 Independent Day special newsletter. Okay. We also had 22 webinars till date, and we have almost lined up the webinars for next 6 months. So few of the benefits. Okay, we have just we have free webinars twice in a month. Okay, then mentoring of newly registered valuers like me. I learned a lot of things from this group, or else mentoring students how to pass this exam. That's again a challenge. Monthly e-newsletters, networking at national and international level. Networking is the key in this consulting world. The more the people you know, the better it is. Okay. We have also performed like knowledge groups and study groups, which will help you to pass this RVO, RV exam. Sorry. Now these are our upcoming events. You can just go through it. Changes in IVS 2020 versus new IVS 2022 by Ankit Goel, and follow on. There are different speakers who will be addressing the valuation issues which we come across. Yes, now it's time to contact us if you want to be part of this association. So our membership head, Nitin sir, will help you to get enrolled in this group. Apart from that, if you have any query, you can always contact Ram Mohan Bhave sir. He is always ready to help us. For webinar related queries, you can always contact Sandeep sir. And if there is anything, we are all as a team happy to assist you. Thank you. Handing over to Natarajan sir.
Thank you, Mario. Okay, actually, our chief guest probably will take some more time to join, so we'll move on with the event. Let me introduce Vishnu, and then I'll hand it over to Vishnu for the presentation. I would like to extend a warm welcome to Vishnu Panaswamy, who is presenting today on the topic Challenges in Startup Valuation and Fundraising. We are all looking forward to learn from you, Vishnu. It is my privilege to introduce Vishnu today. Vishnu has 6+ years of experience with corporate strategy and M&A with startup. As a head of strategy of Exotel, Asia's largest cloud communication platform, he helped the company with raising growth capital and acquiring Ameo, Asia's largest contact center platform, in a multi-million-dollar deal. He has also evaluated multiple startups for potential M&A. He has been advising CEO of German startup Forecasty.ai in developing their strategy, and he holds an MBA from IIM Bangalore. We are all looking forward to hear from you, Vishnu. Over to you. The stage is set for you. Thank you.
Yeah, thanks, Natarajan sir. Thanks, Ramon sir and Mayur, for your kind words. So let me, as I start presenting. So what I'm going to talk about is mostly from a client side point of view. So, most of you are professionals, but valuation professionals, but how does a client think through valuation? I think that is what is going to, will be a takeaway from this session. Further, if you look at startups, startups tend to have valuation needs multifold. Essentially, all startups give ESOPs, so annually startup ESOP valuation has to be done. Other than that, fundraising happens anywhere between a tenure of 6 months to 2 to 3 years. At this frequency, valuation companies tend to value themselves because they tend to go and raise funds from external investors. So from that point of view, I think startups, it's good for you guys to be aligned with startups. There is a lot of opportunity to do engagements with startups. So the way I define startup or the startup community per se defines startups is slightly different from what you hear in public media. Not all early stage companies are startups. So when you begin a company, technically not all of them are startups. So when you have business economics clarity, that is this is where how much is your cost, and approximately you have a sense of how much a customer is willing to pay. When the market is developed, you have a clear sense of the pricing and the cost element involved. You have clarity on business economics. Then it's a new business, but it is technically not a startup. So startups are early stage companies in which the companies have a product, and the companies are searching what is called as a product market fit, wherein you have a product and you do not know whether the customer needs it or the customer will pay for it, at what frequency the payment will happen, etc., etc. So essentially, in startups, the revenue is very speculative in nature. There is a belief that this is going to solve a problem. There's a huge potential, but the exact numbers are not known, which is where the whole challenge with valuation in startups comes from. Because the revenue stream is not known or cannot be predicted accurately. So that's the whole crux of this discussion. So I'm going to give you an overview of what is typically accepted in the startup ecosystem. So startup ecosystem, of course, there are startups, and there's another primary party which is involved, which are your investor communities. Anything which is accepted by the investor community is accepted by the rest of the world, as far as startups are concerned. So I'll again come back to the challenges in startup valuation. Now we have a couple of models, right, such as relative valuation. So often startups are pioneers, especially tech startups. They are a pioneer in their own business industry. For example, when Flipkart started, there was no other online marketplace. So how do you evaluate a company for which there is no competition in the country? Or if you look at the same Flipkart case, the competitor of Flipkart, or the inspiration for Flipkart, was Amazon. Back in 2006, when Flipkart was started, Amazon was not even in India. Amazon started its operation probably in 2011 or 2013, in that time frame. So for Axel India to invest in Flipkart, how do you collaborate, do a relative valuation? There is no listed peer in the market. So when even if there is a peer, they are unlisted. So how do you get hold of that information? So that information asymmetry becomes a problem. There is no model for you to compare and do a valuation. So when you don't have a comparison point of view, then we go to the tried and tested DCF. But here is the challenge. Like I said earlier, the operations model is not stable. Cash flows are unpredictable. So any financial statement at this stage are speculative. There is a lot of room for discussion, and you can always debate and say that the future cash flow projections are incorrect, or it is not achievable, it is not practical. Those arguments come into play. So DCF per se is not applicable for all startups. Depending on the stage of the startups, DCF might be applicable. But for most of the early stage startups, I'll also define what are the different stages of a startup, and then call out which method, how to modify some of these methods and use them. The third thing is they are typically operated in an asset-light model, which is to say most of these companies are software companies. They have minimal physical assets. All they generate are knowledge, which is especially software. And software per se is protected by copyright and not by IP. So how do you evaluate this whole knowledge which is existent with the company? So that also becomes a challenge. So all in all, valuation in startups is very subjective. And the secondary problem with evaluating startups is startups are formed by engineers predominantly, and you have to make them understand about how they are not very much knowledgeable in terms of accounting and financial aspects of running a company. So when you start interacting with startups, you have to be conscious that your customers or your clients are not well versed with the financial world. So when you are engaging with a potential startup in evaluating, number one thing is that you will have to engage with them and educate them about some of these financial terms per se. I think your work starts from there, and then you get information from them, and then you also help them evaluate whether the cash flow statement, the balance sheets, and the profit and loss statements they have made, and how that ties up to the cash flow model. You'll have to start educating them first. Second, tell them whether that is practical or that looks realistic or not, and finally come down to valuation. So a typical engagement with valuation with a startup is actually much long drawn than it would be with any traditional companies, because traditional companies know what a valuation is. They know how to prepare your books of accounts. The clarity exists. That clarity typically does not exist in a startup. So that is something you have to be cognizant of, and that will help you have a better engagement with startups. So like I said earlier, in startup world, the VC or the investor who's investing in a startup forms a key element in valuation in terms of the stakeholders. So there are different classes of investors, and accordingly, there are certain acceptable terms or acceptable, nomenclatures and principles in that investor community. So let us say the first case is where there is only an idea and the team, and the idea per se is not good. There a number of assets are limited. There is huge amount of business risk. There, the lenders tend to be informed lenders. So the regulatory bodies in India per se have put up stringent conditions so that only few investors can invest in these companies. So in terms of institutional investors, the investors who are classified as venture capital funds, only they can get into funding. Typically, when there is only an idea and probably a team, the investment happens in form of equity, does not happen in terms around debt funding.
नहीं मेरे पास क्या हो बेटा कुछ बात तो हुआ ऐसे थोड़ी बोलने वाला
Nataraja sir, kindly mute all participants, please.
Yeah, thank you. So going on to the second stage, where the idea is there, the team is there, idea is proven, wherein the company has built some software product. So that there's again, the physical assets are not there, but at least there is some amount of information asset. But again, the risk is high. Again, the regulatory bodies have mandated that only informed investors should participate here, because again, you have to assess this information, right? The information per se is very critical and very sector specific. At this stage, the investors who step in are called growth equity investors. And this is an investor terminology, but more or less, the venture capital and growth equity tends to overlap. Over a period of time, the company proves itself. They establish a business model. They know how much cash flow they can generate. Some amount of physical assets also start developing, but the risk still exists. Here, there are some set of not exactly public investors, but they're public institutional investors. So you start seeing alternate lending, some PE funds and venture debt stepping in. Over a period of time, when the company matures, then you have a lot of information, you have physical assets coming in. That is when banks start investing in terms of debt funding. Overall, there is a lot of restriction for certain entities which are receiving money from public, such as banks, and there are a lot of regulatory and operational practices within industry per se, which prohibit some segments of investor community from investing in startups. So if you look at investor community segments like banks, banks as in public banks, banks which take your savings money, those banks, investment banks and public equity, they have a lot of restrictions. So they are regulated by their own internal practices as well as regulatory practices, and they are more or less prevented from investing in startups. So the segment known as venture capital or VCs are only allowed to invest in the risky startup businesses. So the whole background assumption is that VCs are informed investors and they have taken adequate precautions before investing in any risky investments. So under that assumption, very few listed VC funds are allowed to invest. Or probably in private capacity, individuals can invest. But predominantly the investment in startup ecosystem is driven by institutional investors who are known as venture capitalists. So this is broadly what I was talking to you in terms of the stages of a company. Stage one, what here is shown as growth, you could take it up as revenue growth per se. Initially, there is no growth in terms of the company is trying to find a market. They are trying to develop a solution. Probably they are trying to write a code and develop a software that will take maybe 6 to 18 months. Once there is a product, the product is at the first level is called as a minimum viable product or MVP. Then the company takes it out to the customer base, and they start evaluating the interest and try to figure out at what price point the customer will buy. This stage probably lasts for the next 2 to 3 years time. By this time, the company realizes that the customer is willing to pay X amount of money for the software they have developed. Then they start exploring how can I sell more efficiently? What are the sales mechanism? And that's when you see again they try different methods of sales. They try telesales, they try inside sales, they try remote sales, they do direct selling, they do partner selling. All the different sales and marketing methodologies are evaluated at this stage. This will probably also take another 1.5 to 2 years. And then when the company has actually figured out all the levers for growth, they have a product, they know the price points at which the customer will buy them, and then they know how to sell the product most efficiently. That is when you will see a steep growth. Once you see a steep growth, this stage is typically known as the growth stage. And then comes the maturity, when the company has grown and probably become a multi-million-dollar company. And then you see they have captured a huge market share. And then the growth becomes normalized to the growth of the economy. So here at these stages, you would see growth rate of 60%, 100%, 200%. But at maturity, it would hit the growth rate of let's say if the company is based out of India, the Indian economy growth rate per se. So more or less at maturity is when you would call the company had hit its terminal value, say growth rate has hit 5% or 6%. But prior to maturity, you can very well see startups growing at 60%, 100%, 200% growth rate. So depending on which stage you are evaluating the startup, you also need to appropriately adjust the growth rate. So I'll just give you an overview of practices which are accepted and how practices are modified slightly for the consumption of startup ecosystem per se. So I'm going to talk about 3 valuation methods which are broadly accepted in startup ecosystem in terms of fundraising or M&A. So DCF is accepted only for revenue stage companies, where the company is more or less before the growth stage, wherein the company has figured out what price point the customer will be buying. So probably if the company has been around for 3 to 4 years, that is when the DCF method will be accepted. Comparable method is accepted for early stage companies and for growth stage companies. Comparable again is modified here. Because a company is a pioneer in India, then you will have to compare. If data is available, then you have to compare it against another startup probably in Singapore or a US-based company. Then how do you correct the valuation between? There are the various externalities in terms of the market. The economy per se.
Pramod ji has joined our chief guest, so we can have his introduction first.
Yes, sure. I'll just stop here.
Namaste, Pramod ji. How are you?
Namaste to all. Sorry, I was still in a meeting, so I came out for a few minutes.
No, we can understand that you are busy. You are currently CCM also and going to be CCM again. So we can understand you are being so busy. Never mind. So Bhaveji, just give a brief remark to Pramodji, and then the formal introduction will be done by Siali. Siali, you are to introduce Pramodji? Yes. So just
Yes.
Yeah. Please go ahead, Sally.
Hello, I am CA Saili Deshkar. On behalf of the Association of Valuation Professionals, I warmly welcome today's guest of honor, CA Pramod Jain sir. He is a chartered accountant and currently a Central Council member of the ICAI. He is also a company secretary, cost management accountant, LLB, DSA, member of All India Management Association, and an insolvency professional. He has also completed several certificate courses of ICAI. His list of qualifications just does not seem to end. He is a senior partner at Lunawat and Company Chartered Accountants for 30 plus years, and he is based out of New Delhi. His areas of expertise include income tax, corporate laws, limited liability partnership, audit, and assurance. He has been a member of more than 25 committees, group, and directorates of ICAI. To name a few, Chairman of Committee on International Taxation. He has been Chairman of Taxation Audit Quality Review Board, Vice Chairman of Committee on MSME and Startups, Chairman of Valuation Standard Board, Chairman of CSR Committee of ICAI. He has authored several books, including Limited Liability Partnership, a Complete Resource Book, Chartered Accountants Documentation and Compliance under Companies Act, Peer Review and Quality Review, Documentation for Chartered Accountants, Taxation Aspects of LLPs, Fringe Benefit Tax, Banking Cash Transaction Tax, and so on. He is a course director and advisor of annual workshops on direct taxes and accounting standards organized by All India Chartered Accountants Society. He has delivered more than 750 lectures on various topics of income tax, company law, LLP, and audit at more than 125 forums. He has written various articles in leading journals on taxation. Sir, it's indeed a proud privilege to have you today with us. I would request you to say a few words.
Thank you, Siali ji, Sandeep ji, Bhavesh sir, and all dear friends. Sorry for being late, and I really am. I apologize to the speaker who has started his deliberation, and I'm really sorry to interrupt in between. But my best wishes for a very happy learning. And if I talk about this valuation, this valuation concept is there, and which is going to improve day by day. If I talk about the valuation under the Companies Act, which has to be done by the registered valuers. So we have been trying from our institute to ensure that any valuation which is required to be done under the Companies Act, even for the Ind AS valuations, that should be done by the registered valuers. And I'm very happy to see that the representation which we made to the MCA has been finally accepted in a way that Schedule 3 has been amended. And in the notes, if you see, it is clearly mentioned that if any revaluation is to be done, in the case of Ind AS or AS, that has to be done by the registered valuer. And if it is not done, that has to be written in the notes to the accounts. So in the notes to accounts, it has to be stated that the valuation is to be done of a PPE. That has to be done by a registered valuer. So that is a great step out there, because we observed that in various cases where the valuation was done for the property, plant, and equipment, that was done by any person and not a registered valuer. So that is a great step, a great boost to the profession of the registered valuers. And of course, if I talk about valuations under income tax, it is they are going by the rule based basically. But apart from the rule based, of course, it is other than the rule based also, asset based also it is there. And the topic which you have kept today, very, very important for the startups, their valuations, the issues out there, not only shares, I would say, but of course, for the startups as a business as a whole to arrive at the valuation for the equity shares thereof, the business as a whole as well as equity thereof, is a great challenge. Great challenge. Keeping in mind whether that startup is actually registered with the DPIIT to get the benefit of the income tax benefits under 56(2)(7)(b) or 80 IAIB, all that. So in that case, you have to be very careful. So take care accordingly. And consider all the aspects, not only the mere valuation as per the valuation standards. ICI also, the valuation standards are there. ICI valuation standards 2018. Then we have got international valuation standards of various countries, I would say. So what is to be adopted is the choice of the valuer. And IBPI, how does it takes the value? It accept any internationally accepted valuation standards. So I have to be very careful. And I'm very sure, and my best wishes to this association, which is to be formed or is under formation. My best wishes to you, the whole managing committee, all the participants and the speakers, and my best wishes to have a great learning session. Thanks a lot. Thank you very much.
Thank you, Pramod ji.
So much, sir. Thanks for your kind words.
Okay, sir. Thank you.
Vishnu, over to you. You'll have to present it again. Thank you.
Yeah. Okay. Thanks, Pramodji, for your kind words. So I'll get back to where I was talking about. So at what what stages, what valuation methods are acceptable for what stages? So comparables are accepted for early stage companies and growth stage if there is a similar industry or available in India or let's say abroad. There we can take representation of it. What is also accepted in the startup ecosystem is what is known as the Berkus method or the VC method for extremely early stage startups, which is where you have an idea and probably not even a team. How do you invest in those companies? So typically you will see companies, someone forms a startup, there are only 3 or 4 people, they have an idea and they raise somewhere between 50 lakhs to 2.5 crores. And then they take that money out and go and hire people who in turn go and build a product and then raise more money to sell, build a software per se. So how does that happen? In that case, when you only have a team, you have some 4 or 5 people and an idea that I can do some business in this sector, and there's nothing in place. How do some of these institutional investors they value a startup, and how do we do that? So that is something which I'm going to talk about for next couple of slides. So the acceptable practice in the startup ecosystem is that in pre-revenue stage, DCF is not accepted. Only in growth stage, which is when the company has started selling the product and there is market feedback and there is an acceptable, what is the acceptable price point. That is where DCF is accepted. But again, many variables are speculative. For example, the growth rate. Not all the growth rate, the companies might put up extremely high growth rate, but then not accordingly, put up costs in terms of sales and marketing cost, for example. So there has to be a one-on-one mapping. If the company is claiming that they will grow 200% in the next 1 year, there should be probably at least 100% or 150% growth increase in their sales and marketing costs. Many startups overlook this because the financial knowledge awareness is limited. So that is something as valuers you will also, as CAs and as valuers, you will also have to talk to your startups and tell them that this is how it has to be done. So since there is no guarantee if the growth rate the startup has committed is 60% or 70%. Those are extremely high numbers. Even if a correction happens by 10-15%, the impact on valuation is extremely high. Let's say if the startup is committed to 200%. From the 200%, if the deviation is 10%, that's 20% down. And the startup commits to 200% growth rate for next 2 or 3 years. So from 200%, when it becomes 180% over the next couple of years because of compounding, the effects are extremely huge. As a practice, any profit and loss model and cash flow models given by startups are heavily discounted. The investors have their own risk assessment. Higher the risk, they will negotiate a higher discount on the paper valuation, whatever number the valuation model throws up. So there is a huge amount of negotiation which take place on the valuation per se between the promoters or the startup founders and the startup, the investors, to arrive at a share price. So what you hear in the media is often incorrect. In terms of valuation, they say a company is valuated at XX million. That is mostly the pricing. The valuation is very different. It could either be at a discount or it could be at a premium. There are times when investors go over and above the valuation and they can pay a premium that is up to their choice, and which also happens. For example, for Uber, in the last, before they went for IPO, the last round they raised, SoftBank led the investment. But by the time Uber was listed on the public market, the valuation had come down. So in effect, SoftBank had paid a premium within a period of less than 1 year. I don't remember the exact value, but within a period of 1 year, the valuation went down. And that is extremely common in startup ecosystem because startups tends to make a lot of commitment in one round of valuation. In the next 1 year period, they might not live up to those commitments, and hence the valuation goes down. And even there is a name for it. It is called a down round in fundraising terminology. So DCFs should be used only in revenue generating stage, and there should be some amount of stability. It is not the first 10 or 20 customers. When the sales and marketing channel costs have been established, only then DCF should be used. I'll go on to comparables. So how does comparable work in the industry? Is that I'll take the same example of Flipkart. So for example, let's say Flipkart was valuated at some XX million at seed stage, which was in 2000, somewhere between mid 2000s, 2006 or 2008. Then let's say Myntra and Snapdeal were started a few years later. But still, Myntra and Snapdeal will be evaluated when they are beginning at the same valuation as Flipkart 4 or 5 years back. That is one method of using a reference point. Right? That is one method because so the time period is different, but you're comparing the valuation of same industry. That is one. The other is so that is when you have comparables within the country and when you have some amount of information available. Now, if you don't, if there are comparables in other industries, then any multiple for this, for the sake of this discussion, I have taken revenue multiple, enterprise valuation by revenue. This should be considered as a median of few companies, and you should account for three correction factors. One is your growth rate correction factor, risk correction factor, and profitability correction factor. I'll just dwell a little bit on each of this. So what typically happens is that you take a list of companies, which could be in other countries, which could be listed or unlisted. If it's unlisted and the company has raised some amount of money, it could be available in some of the databases, like let's say like PitchBook is one such database. In pitchbook.com, if you're a paid subscriber, valuators get access to valuation of specific private companies, which happens across the world. Traction in India also provides such databases, wherein you can figure out at what valuation a private company or a private startup was valuated for whichever stage of fundraising. So I'll go on the correction factor in the reverse order of the formula. So profitability difference. So the same business in different countries can command different profitability, or different businesses in the same country can also have different profitability. For example, a company, a software infrastructure company in US might command 60% gross margin, whereas the same business in India can command only a profit margin, a gross margin of around 40 to 45%. So you cannot take the valuation of the US-based company, which is at 60%, and then compare it, use the same EV by revenue ratio, sales ratio for the Indian company. You will have to correct the profitability. So you'll take out a ratio, 60 by 40, and then you'll correct, you'll adjust for that. Then you have country risk. There are a lot of external risks, there are two kinds of risks, right? One is your country risk per se is captured in weighted average cost of capital, all the country and macroeconomic risks. That is something you all will be aware of. Then the other factor which needs to be adjusted is size premium. Small companies tend to grow very fast, and large companies tend to grow slowly because they've already matured. So at 10 lakhs revenue, from 10 lakhs, it is easy to jump to 20 lakhs. But at a 1 crore revenue, even at 10 lakhs addition, which is a capacity of a company, right? In terms of if the company has 10 salespeople, they can only add 10 lakhs a year. When the company was having a turnover of 10 lakhs, these 5 people could add revenue of 10 lakhs. So the growth rate for the next year would be 100%. Whereas few years down the line, when the company is big and it has a turnover of 1 crore, if you have the same 5 people, they can only add another 10 lakhs. And the growth rate on a ratio basis will be low. On absolute basis, it's the same, but on a ratio basis, from 100%, it becomes 10%. There is a factor of correction which is size premium. The size premium factors can be looked up on databases which are published. There are specialized handbooks which are published for this. So you could look up at some of those handbooks to see what is, depending on the company size, what is the growth size premium which is allocated. So smaller companies will have a size premium wherein there will be, you will increase the valuation. The bigger the company becomes, you will reduce the valuation of the company. Then comes growth rate proxy. Growth rate. Here it's a complicated form. It's a simplified, not a complicated. It's a simplified version of DCF. So it's some form of DCF proxy, but to account for growth rate again, in terms of how historically a company has grown, and what is that you can expect out of the company. If the company has historically grown at 30%, 28%, 25%, then you know that the growth rate is moderately decreasing. You will account for it. Whereas the company has been consistently growing at it, again, you will have to put in those factors. So these are all simple ratios you will take, and if you have taken a list of 5 companies, you will arrange them in ascending or descending order, and you will preferably take the middle value. You will not take the average. The reason why averages are avoided in startup ecosystem is that the investors in startup ecosystem tend to prefer the market leader. So a market leader will be highly valued. They'll be overvalued. So the numbers reported are pricing, not valuation. If you do the valuation of the company, the investors will be willing to pay a premium over the valuation of the company. So the market leader, if there are comparables, of course there will be competition. The market leader will be highly valued. Without taking names, I will give you one example. In a specific communication segment in US, one company is valuated at almost 16 times the sales, whereas the industry averages average multiple enterprise valuation multiple is 1.5x. So that is the variation to, that is how wide the investors tend to value. So if an investor is investing in one of the followers, not the market leader, there will be huge amount of price correction. When you're looking at comparables, they will exclude the market leader and look at the rest of the companies, which is why median is more important than taking an average of the set of companies you are comparing against. Now I'm coming to the extremely basic startup, where the startup has probably not started. There are too many unknowns here. You can ask a lot of questions and there will not be any answers. Answers will be there only in a presentation, or it is only the word of the promoter or the startup founders. In which case, in those cases, it is not valuation per se. It is more of an accepted, accepted culture that at what stage the company is in. Accordingly, the investors tend to give out a certain amount of investment for a standard equity stake. So that in turn becomes a reverse valuation. For example, if the promoter goes just with an idea to do fundraising, the the idea might get up to $500,000. $500,000 of investor money for 25% equity, 20 to 25% equity. Whereas if the same promoter has a prototype of a product, which is they have written a code and it works. You can show result out of it. Then for the same product and idea and for the same company, the valuation, the investors will accept almost twice a valuation, almost 1 million, up to 1 million will be given if a prototype is available. If the startup founders have gone and hired a team, which is excluding the startup, the promoters per se, if there are 3 or 4 of them, they go and hire 4 or 5 more people. They have proven that there is the execution risk is not there. They have capability to hire people, manage teams. Then the valuation again becomes, there's again, accepted pricing of the company becomes different. So it is valued at 4 times or 5 times 1.5 million. Then when sales and marketing activity starts, then the valuation again increases. Then if there is some amount of production and scale, then the product, you have to hire more engineers to make the product and ensure the product works properly. There are no defects. Then up to 2.5 million, or when the product is more or less ready, you have to hire the sales team. Some of the software products take a long time to develop. They take up to 1.5 years to develop. So those are very specific cases where valuation, it happens at a very late stage, where you raise money just to hire a sales team. That happens in rare cases, but it still happens. The growth and profitability, more or less, from this point onwards, somewhere between the production or scale stage, or the 2.5 million to 5 million stage, DCF becomes more applicable. You can start applying certain variants of DCF model. In these stages, relative or comparable method is also applicable. You would also see that I am mentioning all the numbers in dollars terms. So there is an interesting reason for this. The reason is that most of the startup institutional investors, they in turn raise money from another set of investors known as the LPs or limited partners. These are again high net worth individuals or large institutional investor communities, such as this could be pension fund, this could be life insurance companies, or this could be university grant endowment committees. So most of the money which flows into tech startups in India originates from US. So most of the investment in India, at least the discussion happens in terms of dollars, so that it is easier for the venture capital to again report back to their own investors from the limited partners from whom they have raised money, to account that so many startups they have invested in, and what is the valuation. So most valuation you will again have to do in 2 ways. You will also have to be cognizant that the investor who is investing in a startup is not from India, most likely is not from India. Most of the institutional money is dollar money. It is converted into rupees and it's invested in Indian. So I'll come to the last bit, which is the venture capital method. This is you would not see this method anywhere else other than venture capitalists who use this method. You would also have a lot of questions whether this is acceptable under various acts or not. But here, I think the valuation term is incorrectly used. The word which should be rightly used is pricing. So in in early stage companies, the investors, the venture capitals would say, I am investing, let's say 10 lakhs in the business. In next 5 years, I need that 10 lakhs to become 1 crore. So I expect an internal rate of return of almost 35% plus. So what they would do is not look at valuation of the company right now, not today, but if the business is successful, what will happen to the company 5 years down the line, and then do the 5 year after 5 years do a valuation of the business, then divide. So that so-called terminal value here is actually valuation of a company 5 years from now, and then say I need a 35% return ROI from this investment, and then come to a post-money valuation or pricing for the startup. This you will not see anywhere outside venture capital business per se. The company will not be evaluated as of today or its business plan from today to next 5 years, but it is highly speculative model where you look at a business 5 years from now and plan if from year 5 to year 10, how will the business grow and mature? And are there people who will buy out that company at that point in time? And then make a decision on the basis of that. So this is why this whole industry is dominated by specialists. You typically see each venture capital being extremely specialized firms. So I'll talk about a little bit more in the next couple of slides. But startups or the venture capitals tend to be extremely sectorial focused, and they tend to be geography focused. For example, if a fund is around, it will be very specific. It will be software in B2B in India. To this extent, they will demarcate themselves. There are also venture capital funds which are extremely focused on pharma, or there are PE funds which are focused only in manufacturing. So they define themselves. They say these are the boundaries. I will only do businesses for these segments. I will not go and invest in companies outside these sectors and which are operating in countries which are operating in countries which I don't, and markets which I'm not aware of. So they tend to be extremely specific. That is also because they have internal knowledge. These venture capitalists have experts on their team who understand this business segment really well. So all in all, the venture capital method is not expected out of valuers, but it is good to know how this happens. So I'll talk a little bit about the venture capitalists per se. So like I said, venture capitalists typically expect a 10 times return in the next 5 years. So typically when a startup goes for fundraising from a venture capital fund, they assess 3 things. They start assessing the industry. Then they start assessing the idea, and then finally they assess the team. So for example, if I were to start an e-commerce company, then the venture capital would assess this e-commerce business per se. They would see whether e-commerce business has the potential to grow up for, to a valuation of around 1,500 crores or not in the next 5 to 10 years. That too in the next 5 to 10 years time frame. If in the next 5 to 10 years time, if it becomes a 1,500 crore valuated company, are there enough people, are there enough businesses who will acquire this, or does the company have to go public to redeem this value? That is something they will look at the exit per se first, before even assessing the business model. So the sectoral analysis becomes very important here. This is why all the VCs are sector focused, and they are also geography focused. Some of the VCs who are very specific, even to the extent they say that they will only invest in software companies who are based out of India but do business in North American and European markets. They don't invest in startups who build software in India and sell to Indian companies, because they are not aware of the Indian markets per se. Then, given that this idea that this business can be sold in a period of 5 to 10 years time frame at a really good valuation, then the idea is evaluated. So the first thing is 5 to 10 years time frame. How fast can this business valuation grow fast? So mind you, the value this whole 1,500 crores is a valuation. It is not revenue per se. So the company could very well have a revenue of 100, 150 or 200 crores, but still it is valuated at 1,500 crores. That is also possible. For early stage startups, VCs also look at other VCs. So I am giving money to you right now, but for this fast growth rate, I cannot be the only person to invest in you. I need other venture capital funds also to invest in you. So they also look at if other how the investor community is evolved for this particular business idea per se. So you would see if one idea gets funded, there would be a series of ideas around it. For example, when e-commerce, when Flipkart got funded and Amazon came to India, there were lots of startups and which got funded. There were lots of VCs who started investing in e-commerce per se. Similarly, in the past couple of months, when during the lockdown, people started believing in e-learning per se. So all remote learning platforms started receiving a lot of attention from VCs. So there were specific VCs which started investing in e-learning per se. And then you start seeing that many such startups get funded. Finally, when the sector and idea gets evaluated, finally is when the team gets evaluated or the promoter per se gets evaluated. What is typically seen is how mature a promoter is, how good are his execution skills, because end of the day, the promoter is making a lot of promises, and is the promoter capable enough to keep his promises? That is something which a venture capital will look at, and how adaptable are the promoters to market changes. So this is something which is evaluated. So when you see sector, industry and sector evaluation and idea evaluation are extremely expert driven. There is a lot of experience required for this. People evaluation is extremely subjective. How do you evaluate a person, whether the person is good enough or not? That is extremely, it's an art, it becomes an art more than science. So one more factor which happens is that VCs have an investment period. They don't invest in all technologies. If a technology is extremely nascent, VCs tend to not invest in it. For example, if I say voice recognition, 10 years back, VCs would not invest in it, or blockchain. 5 years back, none of the VCs would invest in blockchain or cryptocurrency, crypto startups per se. Because the VCs per se would want to understand how this adoption of this technology happens. So when a technology comes into the market, VCs do not start invest in it right away. They actually wait for the technology to be in the market for a couple of years. So probably when cryptocurrency came into picture and blockchain, none of the VCs would invest. Over a period of time, next 5 to 10 years time frame, they would see the technology per se has standardized, and there is and the uses for these technology is at least proven subjectively. Then comes a period when VCs start investing in a company. So over a period of time, you would see investment in specific technologies like voice recognition, AI, blockchain. Then if you see that there are 100 companies VCs have invested in, then VCs also stop investing in those sector per se. Because there is a lot of competition, you would also see consolidation. You will start seeing buyouts. Just to take the example of e-commerce industry, there are so many e-commerce players. Companies like Snapdeal went out of, they are not doing so well. Companies like Myntra got bought out by a competitor like Flipkart. Flipkart per se got bought over by Walmart. So some companies go out of business, some other companies get acquired. Some companies got themselves listed, like Infibeam became listed in public domain in stock exchange. So a lot of those changes start happening, and VCs stop investing before those major market ecosystem changes start happening. So VCs also have a period. So more or less, it is like a fad. Investment happens for a certain period of time, and then it goes out of fashion. So the takeaway from this slide is that as valuators, you will have to keep engaging with the startup ecosystem. You cannot become a specialist. If you become an e-commerce valuation specialist, 2-3 years down the line, there will not be any need for e-commerce valuation, because the investments in that segment per se goes down. So you also need to keep if you want to concentrate on startup valuation, you also need to keep interacting with startups. Look at which startups are getting funded, what technology are they focusing on. Talk to them, understand how is the business model for that particular technology per se, and how is the business economics. So every 2 or 3 years, you need to keep updating yourself about what is happening in this startup community per se. That is how you will also seem knowledgeable, and you will be able to attract business from the startups. This is just to give you an overview. about startups, how VCs do these investments. VCs also, venture capitals also do a large bulk amount of investments. This strategy will give you an idea how you can be aligned to venture capitalists. That is also one way of generating leads for you. So each VC will at least invest. They'll at least invest in 10 startups. So once you see a fund in India, registered fund in India, they will at least invest in 10 startups. So the idea is this, that out of these 10 startups, at least 3 to 4 will fail. 3 to 4 will give them the original investment, and only 2 or 1 or 2 will produce bumper returns. So accordingly, this gives you two ideas. One is that you can partner with these specific venture capital funds to get leads on which startup they're investing in and where a valuation requirement is coming up. Second is that many startups close down. When I say 30 to 40% fail completely, and this happens in a period of first 2 to 3 years time frame. The general thumb rule is that in the first 2 years, 80% of the startups close, or they shut business or they get acquired. Even acquisition is considered as shutting off business. And in the 5 years time frame, almost 99% of those original businesses are non-existent. These are data points which are gathered from looking at what happened in startup ecosystem in India and US, etc., etc. So once you develop a relationship with a startup, it need not last forever. You will also have to keep looking at other startups because they may be there or they might not be there next year. So that amount of volatility and uncertainty exists in startup business per se. And I was just, I think I've just given you an overview. I think I should not dwell more on this. So all in all, as a summary, before even evaluating a startup, VCs tend to do a sectoral analysis. They tend to do a sector analysis, and they come to they do a pricing per se, that I am only willing to invest in a company at X valuation or X pricing. The valuation might be higher, but I will only do at X pricing. The pricing most likely will be lower than the valuation. And the valuation per se is more dependent on the evolution of a sector than a specific firm per se. And valuation for the sake of investments, they are more of a guideline. So you'll at least have to use 2 or 3 methods to show them that this is the valuation range. Then on that valuation range, there is a lot of discussion and negotiation which goes on, and a discount is agreed upon by the promoters and the venture capitals. And what is reported as valuation in media is not valuation, it is rather pricing. So that is something you will have to be cognizant of. So now I'll flip what the investor perspective to now your client perspective. This is just to give you some amount of information about how typically startups raise money. So how much money should be raised? What source should be a source of capital? From whom should you raise money, and what should be the valuation fund? This is good to know for you guys, because like I said earlier, the financial awareness of startups is low. Hence, as advisors, your role will not just be limited to valuation, but also to giving a variety of advices. And some of them could be these questions which are asked. So these are typical questions which all startups struggle with. How much to raise? What should be, should I raise debt or equity, and from whom I should raise? This is day in and day out. Every startup struggles with this, and you can provide advice to them. So you can be more of an advisor than just be an evaluator. So in terms of how much to raise, what is called as a runaway matrix is how much money, how much of expenditure do you see in the next couple of months. So typically in Series A, which is the first round of investment is called seed. Second is Series A, B, C, etc., etc. It goes on alphabetically. So the first investment seed fund is typically done by using a venture capital valuation method or a Berkus method, which was discussed earlier. From a Series A onwards, it is various other relative valuation comes into picture, or even DCF might come into picture if Series B or later. But typically at a Series A valuation, the amount of funds which need to be raised is 15 to 18 months of runway or expenditure, planned expenditure for the company. And if it's Series B, the fund which is raised is even higher. It is for next 2.5 years expenses for the company. So this also gives you an overview that if you are aligned with a Series A company, you do a valuation now, and probably in a 1.5 to 2 years time frame, your services will be required again. But the more mature a company becomes, a Series B company, specifically in terms of fundraising, the valuation will happen in 2.5 years time frame, and so on. The time frame keeps expanding. The later you go, Series C, B, etc., etc. So the investors typically like to evaluate companies and teams over a long period of time. So as much as a business plan or a B plan is required, wherein you talk about your balance sheets, your cash flow statements, and the profit and loss statements, there is also an accompanying document which is required in terms of an execution plan. How is the company planning to achieve the growth which is mentioned in the profit and loss statement? How is the revenue going to grow? How are the profits going to improve? How are the costs going to be? How are the costs going to decrease? Are they going to be maintained, or are they going to be reduced? How is this going to happen? So the notes need to be extremely detailed. And it should what these notes in terms of the execution plan should reflect is the constraints of the sector per se. In this industry, how does it happen? And your client per se. The constraints of a client would be that the client is based out of Bangalore, and geographical expansion in, let's say, North and Western India is a challenge. So if you need to acquire client, do more business, the company will have to set up sales offices in Bombay and Delhi. That is something which should be explicitly said in execution plan. And also a position of the company after 5 years. Do you continue to see growth rate beyond the 5 years time frame? So even if you are making a DCF calculation at this point, typically we do for you project this cash flow statement for the next 5 years and then look at a terminal value. But then here the position is that even after 5 years, you should have a sense of whether the company can grow fast or aggressively from year 5 to year 10 up to year 10. So those numbers, so you should also encourage your clients to make not just a 5-year plan, but a 10-year plan if they are making a DCF for valuation, right? Because that is something on which a discussion will happen eventually. In early stage startups, most of the investments, irrespective of all the data being available, is capped at 1 to 1.5 million, which is to say around 2 to 5 crores maximum, not more than that, because this is an empirical observation that most companies have not been able to grow more than 30 times in 10 years time frame. The best of the best companies. So all venture capitalists will not give more than a valuation which is not more than 4 million to 6 million for seed investment, which is the first investment of the company. So from whom to invest, the first question, which is debt or equity, mostly it is equity because the cash flow is not predictable, and there is no belief that, and for many startups, for the first couple of years, there is negative cash flow. So debt does not, especially for software business, debt is not a viable option per se. So most investment happens via equity. The VCs with the right industry and geography focus needs to be mapped. There is also a small trick. So VCs also tend to have an investment cycle. That is, VCs raise money in various buckets. So each bucket is valued for, they borrow money from their own set of investors for a period of 10 years. And then they take that money out and they invest in startups. They tend to publish this information that they have raised a fund, and they have a specific name for that fund. They might name it just for public information. So the moment the fund could be $100 million fund or a $50 million fund, etc., etc. So the moment there's something called as a front-end bias. That is, a large number of investments are made in the beginning of the fund life. So let us say today I raise a fund. In the next 3 years, I will make a lot of pre-series A fund. So you should look out for media information. Look at VCs which have raised fund, which have declared that they have raised fund recently, per se. So VCs, in a way, they are also like a startup. They also keep raising funds and they talk about it. So first 2.5 to 3 years is very critical for any fund. That is when all investments tend to happen. And during this period, a large number of investments are made. The value might be smaller, but the number of investments will be large. So more business for you guys. After the first 3 years, the number of investments will decrease, but there will be a higher value of investments because they will go and invest in the same business, which is called as a follow-on round. And typically, you will see that the companies have grown. After 3-4 years time frame, you will see the company has become larger. Their requirement for fund per se is more. which is what I have also mentioned. It comes from 2 points. If you see Series A, you are only planning for a year and a half to 2 years expenses. But if you're going for the next round of investment, you're planning for much longer round expenditure time frame. Also, in Series C, the company will have 50 employees. By Series A, you will have 50 employees. By Series B, you will have 100 employees. So the value of investment per se becomes larger over a period of time. So during the initial phase, a large number of investments will happen. Some of these companies will die down, or they will consolidation will happen, and the companies which survive, much higher sums of investment will be required. So that is something which you will have to be cognizant. Typically, startups need to VCs have a selection rate of less than 1%. So if they evaluate 100 startups, only one gets funded. The corollary is that a startup should approach at least 100 funds or investors to get one round of funding. So this is an extremely number-intensive work, per se. Some of these things is a repeat of what I said from a very investor perspective. So what should you pitch to a potential investor? The startup should pitch that the industry has a lot of potential, and the startup per se has the capability to grow in that industry. So these are 2 things which should come out explicitly in the pitches, other than the valuation and so these are things which should come out in the execution plan clearly. And this is what will back the valuation of the company. That this is a good business idea. This industry has huge potential. This business idea is addressing a significant pain point, or it can increase efficiency in the value chain. We can reduce the cost, effort, do a lot of analysis to back up the numbers you are presenting in valuation, and then come to the people. Also talk about the company, how this company or this firm has a lot of potential, how there's clear strategy, vision, and adaptability here. How people can, how much capability exists, and how much execution skills can happen. So all this has to come out as backups for your valuation. Yeah, so this is just to a brief summary. Raise only as much money as required. Don't raise too much. Don't raise too little. Between debt and equity, there is not really much choice. When you are making a whole list of when the startups are going for fundraising per se, have a list of venture capital lists, and then approach all of them. There is a valuation which is done, but there is a huge amount of negotiation which goes on over the valuation which you might be presenting on behalf of your client. So valuation discounting happens at 2 levels. One is upfront, where the VC talks about the multiple risks associated with the business, and the discounts can also be negotiated post due diligence of the company. There is a round of experts who come in and look at the investor community, the startup per se, from various angles, and then point out that there are legal risks, there are accounting risks, or there are certain people risks. Then there can be a pricing negotiation which can happen later also. So valuation is not set in stone here because there is a huge element of pricing involved. So this is something which the startups should be aware of before they go for pricing, before they should be be aware of the practicalities of what happens in the world, and you should make them aware of it. So that is where I'm coming. So with that, I come to the end of my presentation. So this is my number, and I can also reach me or LinkedIn. I'll be happy to answer any questions you have.
Thank you, Vishnu. Please ask questions. You can unmute yourself and ask questions.
Yeah, I think there are few questions which have been sent to me on chat as well. I will start answering them. I have some 3-4 questions. So first question is, we can till how many years can we call a startup, a company as a startup? So this depends sector to sector. One way to call a startup as a company is a time frame till. So if you look at the sales and marketing cost, if it stabilizes, it becomes constant over a period of time, then you can stop calling the business as startup. For a startup, the sales and marketing cost is unpredictable. So that is one. Pre-revenue stage is one, and sales and marketing cost should become standard. So in software business per se, around a period of 4 to 5 years, after 4 to 5 years, businesses, startups cannot be a startup, they become a company. Only for the first 5 years, you can call them a startup.
Vishnu, there is a question from audience.
Yeah.
Provide the funding process in stages, pitch deck /IM, due diligence, term sheets, approvals from regulators, who define Series A, B, is it the company? It's in the chat.
Okay, yeah. So pitch deck and IMs, okay. So since it becomes an extremely specialized process, there is another set of people who get involved during fundraising, other than valuations. So there is company, there are valuators, and there are investment bankers. So yeah, so investment bankers tend to prepare the pitch deck and information IM or information memorandum, which is a document which gives an overview of the business per se. So this is typically prepared by an investment banker. Due diligence per se comes after. So term sheet is a non-binding document. It's a non-binding legal document, which is explicitly stated it's not a non-binding document, but this is a representation of what the contract will look like. So this comes in picture just before due diligence. So you have an investment banker who's preparing a pitch deck and information memorandum. Then together, the startup and the investment banker go and talk to 100 odd investors. If investors like the company, then they give a term sheet that I am willing to price your company at this value. And then if the startups agree to it, that is when due diligence happens. And once due diligence is complete, then your typical Ministry of Corporate Affairs defined steps come into picture. You have to sign an SHA, you have to amend your MOA, Memorandum of Association, and Articles of Association needs to be changed. So those things come into picture. Specifically in terms of approvals from regulators, the regulators have a light touch regulation here. That is, they don't get involved. Again, going back to the statement which I made earlier, the regulators believe that venture capitalists are experts and they know the valuation which they are doing. So they let the venture capital take subjective calls. So many things around valuation for startups is subjective. So most of the evaluators for startups call valuation an art more than a science for startups per se. In terms of who defines Series A, B, this is just an order. So companies just, this can be the preference share the companies are allocating, and you can give them a name. But Series A, B is just an industry nomenclature. There is no definition to it. It is an acceptable practice to call the first round of investment as seed, second as A, third as B. Some companies can have huge gap between Series A and Series B. For example, the company with which I was working with, the seed happened in 2012. The second round of investment happened from 2012. It happened in 2020. There was a period of around 8-9 years gap before this actual Series A happened. That is, it can be that wide also. But mostly it happens in a period of year and a half time frame. So the Series A, B is a company definition.
No, I have a question.
Yes.
Do you have any inputs on how to evaluate product market fit?
Product market, product market fit is a sales and marketing process. So the broad process is that if the customers are willing to pay for a product, it is that is when the product market fit is a pass criteria. So there will be a stage, for example, if you remember 5 years back, on all e-commerce sites, you are seeing a lot of discounts. And now you see the discounts are reducing per se. So the moment you don't have to give a discount to a customer and the customer is willing to pay full price for a product, that is when the product market fit fitment is considered to be a go. So that's what happens. So so product market fit actually becomes a completely revenue generating idea. If you're able to generate consistent revenue, that is when you say product market fit is a go.
Is it also we should consider in terms of what problem we are trying to solve?
Yes, not exactly. What you're saying is if you're trying to solve a problem for life science, a drug development might take 10 years. So a product market fit will take, a fitment test will take around 10 years to be done. Whereas in software business, if it's a B2B software business, you can do the product market fitment in 6 months to a year and a half. But if you're in commercial if you're in a platform business like e-commerce or payment gateways, those businesses take around five years to arrive at product market fit. But ultimately, the end goal is the same. Are the customers willing to buy a product without discount?
Right.
Yeah.
Any we have from the audience?
I think there are 3 more questions. Please provide an example of adjusted EV revenue multiple. This is actually a long exercise. Typically, it takes around 3 to 5 days time just to make a initial cut. So So I cannot answer this question here. So the next, I'll just go and jump on to the next question. Promoters want to have 51 stakeholding and 100%. How can we offer? Sorry. So when promoters want to have at least majority stake, and VCs typically invest in 25 to 30% equities, it comes in two stages. So the promoters will accept 2 rounds of investment, at least, before their stake gets reduced from 100% to 51%. So that is the bandwidth. So even this 25-30%, it is a rough thumb rule, but it need not happen. It can the investment can happen at 5% also. It can happen at 10%, 15%. More or less, it happens in multiples of 10, 15, multiples of 5 from 10 onwards. But if the promoters want to have at least minimum 51% stake, then they can take investment in multiple stages. They don't have to do in one shot. Yeah, so I think I'll go to the next question. Difference between IM and pitch deck. IM is actually very detailed. Pitch deck is just a PowerPoint presentation. IM will contain few numbers around revenue, unit economics, market sizing. You will have some of those. These days, it is almost used interchangeably. IM and pitch decks are more or less the same. There was a period when pitch deck would only contain the product, and IM will contain all the numbers. What is the market size? How much is the unit economics? What is the potential? How has the company performed in the past 2 or 3 years of existence? What are the customers saying, etc., etc. But these days, it is more or less merging into one document. Documents like SHA, no, these are not done by investment bankers. They don't have the right skill set.
So one more question. Just made a note. What is the right stage to go for seed funding or pre-seed funding? And is it important to bootstrap first and then go for seed fund? Can you just throw some light on this? Can't hear you actually. But freeze. Sandeep ji.
Yeah.
What to do? I think Vishnu has dropped off.
So,
hello. Sorry.
Yes, connected again.
I'm sorry. My laptop ran out of charge. Yeah, so I think I was answering this question on SHA and AOA. Those are not prepared by investment bankers. Those have to be prepared by CAs and. So who prepares these term sheets? Term sheets are actually, those are more or less, these are prepared by lawyers because they are precedent to signing the SHA. So corporate lawyers prepare term sheet on behalf of VCs, and VCs typically have a template. They have the fill in the blanks, they just fill in it and send it to across. So term sheets are more or less standard templates, and they are designed by mostly corporate lawyers. The important things will be the broad valuation, the terms of investment, the rights of the new investor. Does the investor get board seat or not? What are the terms which should come into SHA? That is an ask from the investor, that only if these terms are there in this SHA, only then I'll sign the agreement and invest in your company. So those terms are specifically laid out. There are a variety of ratchets and anti-dilution clauses and a right to participate in future fundraising rounds, etc., etc. So those are the things which are contained. If you just Google up term sheets, I think mostly for startups, you will get a list of things. Okay.
Are there more questions, Vishnu, in your?
Yeah, so I can see only one question. I have one. So again, the question is on risk-adjusted enterprise revenue adjustment. For example, let me give you an example of a company. So the US-based company has a gross margin of, let's say, 60%, and the India-based company has a gross margin of 40%. Then you will accordingly reduce the valuation by 33% of the US-based company. So that is one adjustment. Growth adjustment: if the Indian-based company is growing faster than US-based entity, let us say the growth rate is 50%, and the US-based entities is only 40%, then you would assign a premium to the enterprise valuation, wherein you will increase the valuation by 1.25 times. Similarly, for weighted cost of capital. So in effect, if the valuation of the US-based company is three times enterprise revenue, your sales multiple is 3x. You see, you have reduced for gross margin by 33%, and you increased for ability to grow by 1.25 times. So your adjustment will be 0.67 into 1.25 into 3. So that is how broadly this adjustment happens. So I think I hope I have answered your question. And sir, I think this is it. I don't have any more questions on my message. Do you have any questions?
Anyone has any questions, or should we conclude the session with a lot of thanks?
Time is also,
yeah.
So you conclude with the vote of thanks.
Yes. Okay. Okay. Let me take up the vote of thanks. Okay, it's been a really great session. I would like to formally conclude the session with a vote of thanks. It has been truly a treat to listen to Vishnu today on the topic. I would say the presentation was very insightful. Some of the rare and unknown factors were presented, like startup life cycle and structure of risk levels, and VC only invest in high risk investments, which valuation to be adopted at what stage, clear explanation of various valuation methods and how to adopt it appropriately, detailed explanation of Berkus method, venture capital method. In a short presentation, he has really provided high-level Bible for startup valuation in short notes. I would like to thank Vishnu for taking his time out and research material he has provided. I would like to thank audience who have joined the webinar. Hope everyone have enjoyed the webinar. I would like to thank Chief Guest CA Pramod Jain Ji for gracious accepting our invite and for being our Chief Guest for today's event. Thank you for coming and for sharing your valuable thoughts. And I also would like to extend my thanks to Bhave sir for making his presence in education and his guidance to the association. So thank you all. And if you have any questions, surely you can reach out to Vishnu. Thank you, Vishnu, again. Thanks a lot. Good night and have a great weekend.
Thank you, Vishnu. Goodbye.
Thank you, guys. Been a pleasure.
Very good. I hope you will be presenting the slides in the group, or you can send to Natarajaji, then we will
I have already shared it with Natarajan sir.
Natarajan, you have? Okay. Thank you.
I've got it. I'll share it with you.
Okay. Okay. Thank you.
Bye.
Thank you very much.
Thank you, sir. Good night. Have a nice weekend.